Hello, hello! With the recent news that AMC Corporation, basically the theaters, bought a stake in Hycroft Mining Holding Corporation, I wanted to make a video and talk a little bit about the company, which seems to be about 12% higher, trading about 12% higher today after market. So when the markets open in a few hours, we're probably gonna be seeing a little bit of an increase here. But as people listen to the news, I mean, AMC bought 22%, and I did make a video about AMC earlier today. But I wanted to examine HYMC, this company, just to see whether it's an interesting potential buy. What did AMC see in this company, and why do they want to hold gold miners? And I think they are also silver miners, if I'm not mistaken, as well. So metals is pretty much what they're doing, and mining. Now, whenever I want to hold metals, I prefer holding the actual metals. So, for instance, I would like holding maybe GLD, which is tracking gold, rather than holding the miners themselves. Because mining is a really, really cyclical industry. Like gold, of course, is cyclical as well, but it will never really lose its value 100%. So what you can do with gold is basically buy it when it's low and then sell it when it creeps up higher. That's what I would do. It's very, very cyclical in nature. But for a mining corporation here, people may be looking at this and seeing that it was sitting at about $15, and they will be like, okay, it has received a massive discount. Somebody bought it now, so you may see a trend right now. And this could happen for a little while, of course. And you could see a potential, short-term gain. In which case, I think that actually trading the company is a good idea. But what about actually buying the company and holding it for the long term? Let's take a look at the outstanding shares of the company. That's the first thing. And you will see something that I saw earlier, which really, really scared me here. The company used to have 3 million shares, and now they're having 60 million shares. So do the math. This is hundreds of thousands in terms of an increase in percentage of the stock. And so the stockholders over here got insanely diluted, massively diluted. And this is something that as a stockholder, I would be insanely scared of. So yeah, this is a very, very bad thing, and you hate to see that as an investor. Now, they obviously wanted to capitalize on the increase of the price in order to make some money for the company, but it's a fantastically bad thing for an investor that's actually holding the company. So let's take a look at what the company is doing in terms of income. And again, remember that this is going to be a very, very cyclical company. So, you cannot expect it to continue doing this income forever. Because when the economy goes back to normal, they will start going down. But if we have a recession, they can actually have some insane income here. And right now, this company is actually 2018 IPO. And so you will see that in the past couple of years, it does have some increase in revenues, as you would expect. Yet the net income of the company is actually in the minus, so it's actually negative, even as they are increasing their revenues massively. And so if that doesn't happen now, when will they actually make net income is the question. And balance it now that the gold is actually higher, that's what I mean. So the total current assets of the company are very low. This is a very, very small market cap company. It's 91 million. It's a very, very small company here. Total assets of 195 million, again, very small company, and a total equity of minus. So they're actually losing money in terms of their equity. Now you will see here that they got some additional paid-in capital from investors in the last couple of years or so. And this is basically how they're making their money, just by selling stock to investors, or it will be you if you're buying the stock. Now, income in terms of operations, cash from operations actually, is in the negative as well. What we examined earlier, the company doesn't seem to be making money, and no investing really going on. But for financing, again, it's about the issuance of common stock. Pretty much the whole story here is about the issuance of common stock and a little bit of debt issued in 2020, and some of it paid back in 2021, the last 12 months pretty much. And the free cash flow of the company in the negative as well, and keeps increasing actually, even as the company is increasing its revenues. The free cash flow keeps getting deeper into red territory, so that's something that I don't like to see. And the multiples of the company are sitting at here and there levels all over the place, like 2 here for EV to sales in the last 12 months, but next 12 months projected to be 8, which is much, much higher and more expensive. So the profitability of the company is very high, I suppose, because of debt, and the return on equity is higher, but don't get too involved with that. we're seeing that the company doesn't seem to be making any real return. It seems like it's losing money. Return on equity is a little bit of it can be a little bit distracting because it includes debt as well. So don't take this number too much into account if the company is not really making free cash flow and good net income. So the solvency here is deeply in the negative and very, very high, meaning that the equity is negative, because if we're looking at total debt to equity, the only thing that can be negative is equity here. And so with a lot of debt and negative equity, we're getting a high negative number, and this is the worst thing that you can get. So we're looking at a company that's doing terribly bad. Terribly bad is not even a thing, so it's doing bad. And it has real risk of default in the next few years or so, I suppose, based on the financials again. So you should be careful. And this is not a company that I can actually use a discounted cash flow model for, because its margins are negative, its cash flow is negative, its net income is negative. It's a very new IPO, don't have enough data. But overall, it's a company that I would totally avoid, even as it's getting higher and higher in terms of price. Now, if you want to capitalize on the trend and maybe take it for a swing, like hold the company for a couple of months or so maybe, then that makes sense. That's something that I could do myself, and you could actually end up making some money with taking this for a swing. But remember, there's a lot of risk doing so, and this is not a company to hold for a long period of time, because that will at some point definitely go astray. Even if it's very cheap right now, it can get cheaper. So be careful about that. So thank you for watching the video. I hope you enjoyed, and if you did, please leave a like and subscribe. That really helps a lot. And if you enjoy this kind of videos, take a look at this one that I made earlier. It's about Alibaba, which is up about 24% right now, reaping. So it's maybe beneficial to take a look at. Very interesting company. I'm holding a lot of as well. So thank you for watching this video, and I'll see you soon. Bye bye.